In 2022, Sam Bankman-Fried was one of the most powerful people in modern finance. A billionaire before the age of 30, the public face of crypto's future, a regular guest in Congress, on conference stages, and in the media. 7 days later, his empire was gone. Not because of a hack, not because of a sudden market crash, not because of a technical failure, but because the system he built was never real. Sam Bankman-Fried didn't look like a typical billionaire. He wore oversized t-shirts, slept on a beanbag, and spoke with the awkward confidence of someone who believed numbers mattered more than appearances. He studied physics at MIT, where he became known for thinking in probabilities and expected outcomes rather than emotions. After graduating, he joined Jane Street, one of the most elite quantitative trading firms in the world. At Jane Street, Sam learned something fundamental. Markets don't move because of belief. They move because of structure, incentives, and speed. When Sam discovered cryptocurrency, he saw a market full of inefficiencies. Prices varied wildly across exchanges. Rules were unclear. Oversight was minimal. To most people, this looked dangerous. To Sam, it looked like opportunity. Sam believed crypto markets were irrational but predictable. If you were fast enough, smart enough, and willing to take risk, you could extract enormous value. In 2017, he launched Alameda Research, a trading firm designed to exploit price differences across exchanges. Alameda made millions by moving faster than competitors. But Sam wanted more than a trading firm. He wanted infrastructure. He wanted to control the system itself. That idea became FTX. FTX launched in 2019 as a cryptocurrency exchange, but it wasn't built for beginners. It was built for professionals. FTX offered high leverage, complex derivatives, custom trading products, lightning-fast execution. It didn't try to feel safe. It tried to feel powerful. Professional traders loved it. Then came the money. Venture capital firms poured billions into FTX. Some of the most respected investors in the world backed Sam personally. Celebrities promoted the platform. Sports arenas were renamed after it. At its peak, FTX was valued at over $30 billion. Sam wasn't just a CEO anymore. He became crypto's ambassador, the responsible one, the adult in the room. Sam carefully cultivated an image. He spoke openly about regulation. He donated to political causes. He positioned himself as someone who understood risk better than everyone else. To outsiders, he looked like the rare combination of genius and ethics. Someone who could move fast without losing control. But behind the image, the structure was already breaking. FTX was not just an exchange. It was deeply connected to Alameda Research, a trading firm Sam also controlled. On paper, FTX and Alameda were separate companies. In reality, they were tightly intertwined. Alameda took massive risks in crypto markets, and over time, those risks turned into losses. Instead of shutting down trades or admitting failure, money quietly moved. Customer funds from FTX were transferred to Alameda to cover losses. This wasn't a temporary loan. It became a dependency. FTX customers believed their deposits were safe. They believed funds were held on the exchange, available for withdrawal at any time. But behind the scenes, there were no real safeguards. There was no proper separation of funds, no independent risk management, no reliable accounting system. In one internal document, billions of dollars in liabilities were tracked using a single spreadsheet. Not a robust financial system, not audited statements, just a spreadsheet. As long as markets were calm, the illusion held. Everything worked as long as no one asked one simple question. What happens if everyone tries to withdraw at the same time? The answer was devastating. FTX didn't have the money. In November 2022, that question finally arrived. A leaked balance sheet revealed that Alameda's assets were largely tied to FTX-issued tokens. Confidence cracked. Customers rushed to withdraw funds. Within hours, billions of dollars left the platform. FTX froze withdrawals. A last-minute bailout attempt collapsed. And within days, the company filed for bankruptcy. An empire that took years to build collapsed in under a week. Over $30 billion in value disappeared almost overnight. Millions of customers lost access to their funds. Employees were locked out of systems. Investors realized there was nothing left to save. What shocked observers most was not the speed of the collapse, but how little structure had existed in the first place. The company had grown too fast to notice its own weaknesses. Regulators and investigators stepped in. What they discovered stunned even seasoned professionals. There were no reliable financial statements, no formal board oversight, no independent audits, no clear record of where money had gone. One official later described the situation as one of the most complete failures of corporate controls in modern history. Sam Bankman-Fried was arrested. The man once portrayed as crypto's savior became its most infamous warning. This wasn't just a crypto story, it was a story about power. FTX didn't fail because technology failed. It failed because fundamentals were ignored. Speed replaced structure, trust replaced verification, charisma replaced accountability. The same traits that fueled the rise made the collapse inevitable. History repeats this pattern. When systems grow faster than controls, risk becomes invisible. When belief replaces oversight, failure becomes certain. FTX was not an exception, it was an example. Sam Bankman-Fried once said he wanted to change the world. Instead, he proved something far older and simpler. No system survives without controls. No innovation survives without discipline. And no empire survives when no one is watching. FTX wasn't destroyed by the market. It was destroyed by the belief that the rules no longer mattered.